1 second, let me reconnect. I just broke the system. Okay, we're back. Welcome everyone. I am today talking again with Bernhard Rannegger about all matters insurance, all matters risk management. And we are live. So if you're watching us on LinkedIn or YouTube or Twitter, feel free to ask questions, write comments, and we will try to respond to them. I've just tried to refresh the page to see if the broadcast started on LinkedIn, and that crashed my whole computer for a second. So thank you, LinkedIn, for that. I wanted to start today with two pretty amazing experiences, because at the moment in my day job, I have two renewals, one for a property policy and one for a liability policy. And it's interesting how starkly different um, companies, underwriters, engineers, and brokers approach the renewal process. For one of the policies, I've received an email saying this is kind of the renewal document. Please review it, update the values if necessary, and sign it so we can renew. To which I said, hold on a second. Every renewal is an opportunity to make sure the risks are properly reflected. And it's more than just a formality of updating the values. If our risk profile changed, we have to capture that and we have to communicate that to the underwriter. To which I just said, I would like to have a proper meeting with the underwriter at some stage, but more importantly, I've asked the broker to prepare a list of key decision criteria, key points that the underwriters use for pricing, so we can actually update both the broker and the underwriter what's been happening in the year. So I want to take it much more seriously, even though it's not a particularly expensive policy. I do have some time. I'm not in the rush. We are starting the renewal many months in advance, so I want to do it properly. I want to understand what drives the decision making for that specific product, and I want to make sure I'm providing all of the relevant information to the underwriters to make the right decision. And also, every renewal is not an automatic renewal with the existing insurance company. It's a conversation with the markets to understand what is available in the market in general. So that was the first conversation. But the second one was, I think, even more interesting, because that was our major policy. And I had a meeting with the head of engineering and our main engineer and our main underwriter on that policy. And I thought kind of the original plan for the call was to just talk through the engineering recommendations and give an update on what's been happening. But as I started talking through that, what I realized is that a year is actually a very long time. So many things have changed, and we take it for granted, like we don't really think about that. But our company today compared to our company a year ago were significantly different. So many decisions have been made, so many things have changed in the market. Obviously, the war in the Middle East has a huge implications on the supply chains, on the demand for our product, on the pricing. Just a lot of the assumptions that we used to make for BI, a lot of the assumptions that we were making for the recovery timeframes, most of these assumptions have changed completely. So I went into the call expecting just kind of cycling through the recommendations, giving an update on what sort of engineering we're doing, what sort of budgeting we're doing, what has been completed, what is outstanding, just a very technical conversation. But what I realized is that in just a year, and technically speaking, it's even been less than a year, in 3 quarters, our business has changed so much that it deserves a full conversation with the underwriters explaining our technology again. We're investigating different alternative technological routes to improve recovery of the product. And while I take all of this for granted because I've been living through that, so to me it's obvious, like the risks are manageable, they're not significant. But when I just kind of in the passing mention that to the engineers, they kind of start making their own assumptions, saying, well, I've seen this technology being used elsewhere, and it was risky because it was different height, different reagents. Everything was completely different to what I have in my mind, but they already started making like all sorts of assumptions about the riskiness of the underlying process. And I just went like, oh wow, like it's such a nice wake up call, going, oh, I like it's a full-time job explaining your risk profile to the underwriters, because nobody can read your mind. Nobody's really deep inside your technology and your location. Another fascinating thing is me as the head of risk, I've done like a deep dive investigation into how a climate change, and specifically El Nino, La Nina, will affect our specific mine site. And surprisingly, it actually looks like we would be revenue positive as a result of that. Like, unless it goes like it reaches certain threshold and it goes like super dramatic, we're actually net positive because we expect our mine site to have less rainy days over the coming decade, and dry days produce a lot more product and a lot more revenue than rainy days in Brazil in general. Um, and all of this needs to be explained because people just are not aware until somebody tells them, and kind of really builds this narrative. I've also talked about the digital twin that we have, and I think that got people pretty excited because we we are now in the position to being able to simulate certain risk scenarios, and it's interesting to see how it kind of plays out compared to a usually quite a conservative estimates that the insurance underwriters are providing. So so many benefits in having those regular conversations with the underwriters and the engineers, and so much information that sits in the risk manager's mind that usually doesn't really make its way into the insurance conversation, and it costs real dollars. All of this silence is costing a lot of money. So Bernard, that was a long introduction by me. What's your experience? What are your thoughts on this?
No, it was some beautiful points that you directly mentioned. Like, I think like there's two that I directly want to pick on and pick up, right? The first one you mentioned was more around like this context, this how do I normally describe it? Like, is this valley of depth of context, right? So you just like described, like, you as the risk manager, you obviously know the risk of your company best. You know the context. You day by day, right? Actually, work on it, right? How is the underwriter supposed to know all of this? Like, how can you actually like translate and share the right data, the right information, the right risk? And I would say like even like create an inception where you provide like your view that you have like to the underwriters, that they can make the best judgment that they can do, right? Like the accurate one, right? I think that is so beautiful, like where we actually, and I think you're doing a great job like on really bringing over this context in a way to the underwriters, to the market, actually, that they actually grasp it and understand it, that they can actually price it more accurately and be nearer like to this actual risk profile and actually price in the end, the risk profile. So I think this is this context piece where we want to really like get like as much and the right information actually to the underwriter, that they actually can price the risk accurately. And I think that this is really like bringing over the context into the market through digital twins, through a risk digital twin that actually provides like the right data at the right time to actually have like this shared understanding of what the risk looks like. And then the second piece that I directly wanted to pick out there was super interesting what you just like shared of the mind that you guys have, right? Like in Brazil, like that, for example, a certain change to climate, like can on the one hand side, like be detrimental and can leave like, actually you can have like a stranded asset, right? But again, it depends so heavily on what you have there. If it's a mine and if you actually benefit from dryness, right, and you can actually work longer and it's actually like better for business, right? This has to be somehow like, you have to be able to assess that. It's a completely different thing if you like have a factory like where you produce like chocolate, right? And suddenly like the average temperature is like two degrees higher or whatsoever. And you just have to invest so much more in cooling. Actually, like in the transport doesn't really work anymore because your quality of product goes down, right? Because you cannot heat up the chocolate too much, right? Versus like having the mine, right? Like where and this may be some crazy opposite examples, but it's just like how I think about it. Like we actually have to put the risk into context. And there's a huge difference now. Is it more drier? Hey, that's actually good for business versus it's drier and I'm not going to have like enough water for my crop, or I don't have enough water to actually produce my bottled drink. Like if I'm Coca-Cola or something like that, I need water to actually like produce my product. So if this actually leads to a certain dryness and scarcity, then there's a problem. And this is like this beautiful thing of contextualizing the risk and really like bringing it down to what does that mean for you, for your business model specifically. And then the other part, like actually bringing this into the market, the right accurate picture as you see it, helping like you actually helping then the underwriters and these other people to understand you better. And this is also like how I see the industry working better, creating this transparency on the risk.
I mean, I think it's and I think it's fair to kind of call it win-win, because it's better for the underwriters to appreciate and understand the risks that they're pricing, and also not be intimidated by the wrong assumptions, because I'm finding that's the biggest challenge. As we were talking about this, alternative technology. Immediately the engineer started describing his experience with the technology, which was a completely different industry, completely different type of technology, but it suddenly sounded really scary. And then I said, well, actually, for us, this technology application is completely different. Instead of 30 meters, it's 1 meter high. Instead of heavy acids, it's a fertilizer. Just completely different worlds. And that puts underwriters' mind immediately to rest, because they go, oh, okay, it's not actually increasing our portfolio exposure that significantly. And it's a win-win for us, because we want to be priced on our underlying risk. We don't want to be priced on some hypothetical, Brazilian mining risk that somebody somewhere has imagined in their head. So yeah, I was actually, today was surprisingly enjoyable, because what I thought would be like a quick formal conversation actually turned out into this, light bulb moment, going like, oh, that's why ScyAI exists, because we really need to not just capture the risk profile once, but we really need a place to to constantly update what's happening to the risk profile, new new technologies, actual equipment performance, incident rates, just everything that happens throughout the year significantly shifts the needle. And I mean, for us, again, this is so huge that since my previous policy initiation date, US government essentially went out and started creating a whole new alternative market for the rare earth minerals, and they've been quite successful at doing that by establishing floor prices, by building demand, by speeding up processing capability, both in US and the European governments are kind of doing the same thing in the Australian government. So in a year's time, the whole industry changed so dramatically, and that obviously has a huge impact on our BI exposure, because in the past we had limited number of clients that were paying specifically kind of indexed price with lower volatility. Now we have a lot more upside, but that means as a business this is an amazing place to be in, but also what this means is that our insurable losses are significantly greater as well. So we need to now make sure that our policy essentially catches up with what's happening in the market. So the market, the market has grown so significantly. We now need to make sure that the policy kind of steps up. Now, the good news is that because we're good at risk management, we knew this would happen. So we anticipated it back when we did the initial policy. And I am 90% sure then when we do the whole recalibration and reassessment, our existing limit and our existing assumptions in the policy would be still sufficient, even under a completely different market reality. I'm 90% sure, because we've really built into that volatility into the original conversation, because that's exactly how we were discussing it. Like, what happens if the market changes? Is this policy still going to be a good fit? But by the way, again, not something a traditional insurance conversation would have, because the underwriters asked us for our revenue projections, and the revenue projections are coming from a financial model, and the financial model comes from an approved budget, and approved budget usually comes from something that the board and the shareholders have agreed upon, and that is usually based on some sort of like very stable, solid assumptions. So if there is a small probability of huge market shift and a completely like different game, that wouldn't be in your budget, because it's it's a small probability scenario. It's not your main base case. Your main base case is what you have in the budget. So if we went down the route of traditional approach of saying, give us your revenue projections for the next few years and use that to calculate BI, our existing limits would have been significantly lower than what it is today. And then we would most definitely be underinsured given all the changes that have happened. But because we didn't look at just the kind of the base case scenario, but we also looked at plausible alternative scenarios when we were negotiating the original limits, our original limit was already kind of built with enough headroom for that upside scenario, which happens. So good world to be in when upside scenarios happen. But it's amazing how important it is to think about uncertainties and risks when you kind of communicate what your risk exposure is, because otherwise there's a very high chance that companies would be significantly underinsured. I mean, I suspect a lot of the businesses that didn't really kind of forecast something like a Middle East war, and they were insuring cargo, they were probably insuring, setting cargo limits at the old prices, which were now significantly exceeded, at least for certain materials.
Exactly, 100%. And just like what this directly fires as well, right? Like just listening to you, Alex, and I think like a lot of listeners and also people that follow you for a while would probably agree, right? Like that now you outline like a lot of the stuff that has to be done, right? Like we want to contextualize the risk. We want to create it in a way like where we have like a source of truth, right? Where we have our risk digital twin that we can then work towards to actually create the context on our side, but then also then transfer it into the insurance market. And now you like with regards to all the sub-limits, all the challenges that you just like described. I think like what I hear a lot from the market, but also like playing a little bit devil's advocate here, like probably listeners would say like, okay, hey, we can now do all of these things, etc. But I'm so limited right now with regards to, hey, I have like maybe a small team, maybe I'm a one-man, woman show, etc. Like how I'm actually going to follow up all of these, like how I'm actually going to follow through and do all of these things. And maybe people feel a little bit overwhelmed, right? And I think there it's also like so interesting what we have seen now with Sci and how we built it, right? Like we actually can get like this leverage for the people. Because what you describe, right, and how you are set up, right, there's like certain ways on how you do these things, but there's also, it needs certain foundations that have to be in place, right? You have to have certain data already in place. You have to know already like what policy actually, like what clauses are good and bad, like how you actually think about the market, how you actually want to position like your risk, etc. And I think like a big problem that the people that I talk, the insurance and risk managers that I talked to so far is like, okay, hey, we struggle like with the tooling. They do not find the right tooling to actually get that leverage. They don't have enough time to do that. They feel like, okay, they don't have capacity. They don't have like enough FTEs actually to work that through. This requires so much analysis, etc. And I think where this kind of comes actually then this unlock, and I think that's what we're seeing internally now here already, like we have to provide the insurance and risk managers through Sci like the leverage that they have like through a team. Like we want to have 10x leverage Alex, right? Like in a perfect world, like you would have like a team of multiple Alexes and your team that you have right now, right? To just like analyze the risk profile, like prepare all of these different submission documents and in a way like that you can go out to the market and have always like the right information at your fingertips. And I think this is like something where we want to leverage the insurance and risk manager, which is also like how Sci operates now, right? And just like whoever who does not know yet what Sci is like actually the agent behind ScyAI, which is literally like an artificial intelligence that becomes like an extension of yourself. Think of it more like a person, a remote employee that you delegate stuff that you can actually get this leverage from. Because maybe you feel overwhelmed, like, hey, yeah, Alex is telling me like we have to do that and all of these beautiful things, right? That absolutely makes sense. But then you maybe see like, okay, you look at your calendar and you're just like swamped with all of these different things. And that's what we are solving here now, providing you the leverage, giving you like PhD quality firepower to just like leverage your own judgment. You still stay in the cockpit and steer the boat, but you get like all of these leverage from it to actually quantify your risk profiles, to review these policies, to actually map them, see and model them. What happens if I have a claim, right? I want to simulate these different things. And just like having that at the fingertips, I think just is going to be so powerful. And yeah, that was just like the direct thoughts that were triggered on that. Like any comments from your side on that?
Yeah, so that, I mean, yeah, totally agree. I mean, this is, I think, the future of insurance management. The one thing that I found super curious, I was just checking if my mic is working fine. The one thing that I found super curious was the we have, you know, as part of our company, we went through quite a few kind of exercises and external simulations, and we do have a very interesting digital twin in the company as well. But one of the one of the really kind of surprising and amazing things that I've discovered is that, you know, policy document kind of outlines the rules by which the insurance as a product operates, and when you read it as a text, it all makes sense. You know, some policies are clear, especially, you know, the ones that are kind of written on the default insurance company language. They have very clear and specific weak points that transfer the risk back to us from the insurance company. So the insurance companies kind of are using some tricks to really limit their exposure, and those are kind of understandable and also those are easy to pick up. And you know, Sci kind of does a pretty amazing job at that, like reading the policy and finding all the little tricks that the insurance companies are trying to play. But what I found surprising and eye-opening to me is that until you start talking about specific loss scenarios, until you kind of start walking through the process of what may actually happen, and especially what local legislation will kick in, you don't really get a grasp of where the missing points are. Because on like you read it and it reads fine, like everything makes sense, and the wording seems to be appropriate and fair, and it's reasonable. But then when you actually, you know, like war game or simulate a potential claim scenario, you realize that that interpretation that you thought sounded fair could actually be, you know, have double meaning, and it can be interpreted in various ways, and it's actually ambiguous what is implied beneath that. And you know, when you have a friendly conversation without a claim, the insurance company may even imply that your understanding is consistent with their understanding, until, you know, the lawyers get involved, and then suddenly all this ambiguity is used against us. So what I'm finding amazing, and I think like I'm kind of curious, you know, if anybody's doing that, because, you know, please write in the comments and or reach out to me or Bernhard separately. This is fascinating. This is not something that we have been doing in the past, but this is something that we will definitely start doing now, is actually simulating a claim, you know, a loss that gives the rise to a claim, and then just living through the cycle of what's happening with the policy. You know, for example, you know, it's so many nuances. What was surprising to me is, you know, who would be the loss adjuster? You know, that's like a random company somewhere in a different part of the world that you've never even heard about, and you go, okay, well, now I need to figure out, well, who are these people? You know, what are their competencies? Are they on our side? Are they on the insurance? Like, what's actually going on? And then certain losses which everybody assumed are just automatically covered, you suddenly discover that they are, but not always, not really. And then there's like all sorts of weird sublimits that kick in. So as I've been kind of living through the last year and a half with digital twins, I think the future is really just simulating all the plausible, uncertain things, and just seeing how it plays out, because it is extremely surprising what you think will happen to what actually happens. And simulating through that, even with it, and I think it's the same with losses, even not just how the policy responds, but also how the loss will actually affect the plant. You know, wildfire is a risk that seems to be intuitively well understood. Like, you can imagine it, you've seen videos of it, like you can see how it can play out in your mind. But then when you actually simulate it and you see the physical spread and the speed of spread and the impact and the kind of the mitigations kicking in, not being able to kick in, all of that makes risk management so much more tangible. So I'm hoping we can get to a stage where we will be able to see and like almost physically feel the future risks. So then that can be translated into better insurance coverage, and probably even more importantly, into better risk mitigation, because at the end of the day, you know, insurance coverage is like our last resort, trying to recover some of the losses. But the reality is we should be aiming, and this is kind of the side benefit of what I'm seeing, is as we're doing this investigations and analysis and understanding of our risk profile, that helps us to understand how to mitigate the risks before an insurance even kicks in.
Exactly, and I think like how I would describe it, like how this is going to look right now, like, or how, if I extrapolate further, how ScyAI is developing right now. You get like this team of 10 PhDs working 24/7 on simulating your different risks, and you go back in there and check, okay, hey, how is this like looking now for wildfire? How is it looking for that, etc. Constantly contextualizing, constantly also memorizing like interactions from 10 months ago, risk engineering reports that you did like a year ago, etc., and constantly contextualizing it, wiring intelligence through this, wiring intelligence through your risk digital twin, through your context, how you go to the market, the different policies that you run, and just like understanding your own ecosystem while you being like in the cockpit on pushing forward on making your company more resilient, making like sure business continues, making sure you allocate the capital as good as possible, not only into the different insurance programs, but obviously looking at it holistically. Like what is actually the part that we can risk engineer away, what is the part that we manage like in other certain things, and what is the things and parts that we actually insure away, where we risk transfer. And I think there it becomes very beautiful, just like having like this high level view and then being able to really go very granular, but without running studies over 2 weeks or whatsoever. Literally having this AI intelligence, like do like the certain analytical work for us, being able to access like our data using like the best-in-class tools, the best-in-class NetCat models, and us just really exploring all of these different paths that risk can go.
Switching gears, I mean, that's what excites me about the kind of next iteration of AI, and I think, you know, ScyAI is already there. I believe I have mastered the skill of having a conversation with the chatbot, as in like and so yesterday was April's Fool, and I had an idea of writing a Maslow's diagram, because I think we talked about this.
Yeah,
Just
we did.
it triggered in my mind. I literally put a note to myself, write a Maslow diagram for risk managers. So I had an idea of creating a Maslow's diagram for risk management, and because it was April's Fool, I used AI to create my vision of what the Maslow's diagram should look like. But because it was April's Fool, I then said, you know, create me the inverse of all the nonsense and all the you know, marketing rubbish that is usually what I call risk management one. And in both instances, it did an amazing job. But it was me kind of strategizing, creating, and then AI just writing it in coherent sentences. It was, you know, I created it, and then I had to explain my vision to AI for AI to kind of write it up. And because I use one of my own agents that has been trained on all my articles and all my videos, it does a pretty good job at translating my thoughts into my, you know, my language as well. So it did an amazing job. But it's very involved. Like the version that I published, and by the way, you know, world is a very ironic place. The real one, I think, got 50 likes, and the joke one got 120 likes, and a lot of people took it seriously. Like all the nonsense that I was writing, I was purposefully being just as silly as physically possible. A lot of people took it seriously. It just went like, yes, great, like but it's missing something. And I'm going like, it's missing everything. It's meant to be wrong. But anyway, the version that I finally published is like iteration number 11 or 12.
Mm-hmm.
So I spent quite a lot of time trying to refine and, you know, make it mutually exclusive, collectively exhaustive, and just, you know, make sense so it's coherent and it's connected, and it captures all the philosophical things that I wanted to capture. So it took a lot of effort, and I'm really looking forward to the world where the next iteration of AI, you give a task and it just goes away and develops the methodology, fact checks the methodology, pulls in the right asset data, pulls in the right financial data, pulls in external risk exposure data, internal risk analysis data, finds inconsistencies, mismatches, figures out how to deal with that, and then does the analysis, fact checks the analysis, and then finds a way to present it in the format that actually helps to make a decision, whatever is the decision at hand. So I'm really looking forward to that next iteration where there's a lot of multi-step doing, not just human in the loop at every single stage. That's now quite daunting. I'm looking forward to the world where AI has a lot of autonomy to deliver the full draft, not the zero shot, not the multiple shot, but really a draft that is the product of multiple thinking steps and lots of validations, and it's actually based on coherent memory, corporate memory, and so on. So I think that will be an amazing world to live in.
100%, right? And that's the world I think where we're working towards too, and where we're already quite close. I mean, you probably have seen that Claude Code actually got leaked, the agent that actually, or the agent harness that they're using for coding tasks and stuff like that, where they are already doing proper long-term memory stuff and so on. And the engineers like Vaishnav and co looking into it, right? We actually realized how our memory system is already more advanced for these long-term tasks. So I'm super excited about that piece now, right? When I say human in the loop, as you mentioned, it should be more like a steering, but not at every incremental step. It should be actually you steering based on the high-level direction, giving feedback on an artifact that is already produced, right? And only looping you in at the right points, right? Where maybe otherwise the AI, the agent, would make an assumption. It's better to loop in the user, right? Do you actually maybe have already additional information on that? Otherwise, it just goes further, right? And it literally becomes this partner in your journey, where it should feel as you're Robin to your Batman, right? And constantly pushes forward. And instead of us doing this analysis over 2 weeks, waiting for additional data for brokers and stuff like that, we just do it in an hour, 2 hours, etc. And then when you go to sleep, you let the agent continue to run, and in the morning you actually see what are the cool scenario visualizations, the modeling, etc. it has done, and you just directly pick off where you left off. It also reminding you, hey, these different projects that we run, Renewal we run right now, but also here we have a certain acquisition going on where you have to do due diligence, and also here came a policy in that we have to review still and give feedback to the broker to actually get the policy properly. So I think this is a super exciting world where just I think the people are not prepared yet how much leverage you're going to get out of that. They're not prepared yet how much this is going to not only speed up things, but also improve quality in context of actually getting the risk profile quantified properly, not being qualitative, just really down to the numbers, and then being able, having the capabilities to translate that into the right format for the market proactively.
Totally agree. Yeah, I mean, exciting times, and I am glad we are at the forefront. We are on the edge of this insurance risk thinking.
Exactly, and I think it would be beneficial probably in the next session we directly show some examples, right? I think that the people probably would love that too.
Yeah,
I mean, live, how to work with the agent and stuff like that.
Yeah. The latest thing I was super impressed with, and that was actually quite crazy. One of the engineers asked ScyAI to explain what it's good at, and it actually did a better job than I would have. I was looking at it going oh wow, this is so well structured and so spot on. It's pretty amazing. This is, I think, one of the pleasures of working with fine-tuned, purpose-built AI agents and models, is that it constantly surprises by the quality and just the insights that it can generate. ChatGPT can't do that.
No, 100% not. No, and the beauty of what you just like mentioned is super exciting actually, where you start like ScyAI having an understanding on the architecture, how it's built, right? The tools it has access to, like, and how it works itself. So it can do this self-reflection. And I think I shared with you like this one output where I was brainstorming with itself, like of an idea that you had actually that we would actually utilize. And I would share it with it, and it actually would go back and forth with us. Yeah, no, that makes sense. That makes no sense. Like, and it was very opinionated.
Yeah.
And here's how we can directly implement it. And it starts building itself. It can start extending itself. And this is like obviously like on big architecture stuff, but also in other things, right? Like there was literally this surprising thing where I was doing a flood analysis, and so I got frustrated because it didn't have access to a certain flood data piece. Like I think it was in Holland and in the Netherlands, like a specific publicly available one. And it literally like built its own sandbox to access the API of this government data source, pulled it in, and then could actually use it. So when you go down that road, it's gonna get wild, like, and super fun to be an insurance and risk manager, just like proactively assessing and using it. Like the leverage that the people are gonna get out of that, I think they're not prepared yet.
Yeah. I mean, mind blown. By the way, if you're watching this in replay and you want to sign up for a waitlist for ScyAI and talk to Bernhard and see some demonstrations, here's the QR code that goes to the homepage for the sign up. I have a few more amazing stories to share at the next session. And we will start doing some demonstrations soon. Also, this, we haven't really announced this session, so I suspect a lot of the people will watch this in replay when we start actually posting the links to the groups and inviting people to watch this on either LinkedIn or on Risk Academy YouTube. You can watch the replay as well. Ask questions below, and then we will use these questions for the next session. Hope you guys enjoyed it. Any final thoughts, Bernhard, from you?
No, all good. Like, it was exciting as always to talk to you, and hope we get like a lot of questions and comments, and we take it from there to be continued.
Perfect. Speak to everybody soon.
Have a good one.